Here's a look at ARK, down 58%, we'll call it, off the year high. She was with us yesterday. She defended her stock picking prowess. She defended her research. She was defiant in terms of saying, yes, these stocks were in a bubble. And she claimed many are in deep value territory. Listen.
We believe our portfolios are extremely undervalued. You have to have a 5-year investment time horizon. And if an investor is looking for returns over the next quarter, the next 2 quarters, we can't promise them. Nobody can promise them. That's a macro call these days. However, if you give us 5 years, I will tell you, we are running a deep value portfolio.
Steph, she said, we right now have, quote, one of the most misallocations of capital in the history of mankind. Conversations about valuation don't seem to really matter with Cathie Wood. She maintains this 5-year time horizon. So checking her on a lot of stuff like that remains difficult, right? Because it can always be the fallback. Well, our time horizon's 5 years, so who cares what the stock does now? If you buy these stocks today, you're going to be supremely happy in 5 years because you've made a tremendous bet on innovation, and anything but that or seeing it that way, you're simply missing the boat. I'd love to get your take on the points that she makes here about a lot of these stocks, which many of our viewers have owned and unfortunately have ridden down so far.
Yeah, I mean, anything can happen in 5 years' time. That's impossible to gauge, right? So momentum is really good on the way up, but on the way down, you're catching a falling knife. There's no valuation support. And so when you're looking at price to sales, total addressable market, which I have also done in terms of trying to see big picture and where their market share of certain companies can go. But the market doesn't want that right now. They don't want the non-earners right now. There's no way to value these companies other than to think about out in 5 years what the markets are going to look like. And again, especially in technology, things can change on a dime. I mean, look, you go back to Amazon. It's actually trading at 45 times earnings. I think that's one of the cheapest it's been in a very long time. And that can't get out of its own way because the investors in the market right now, they're not rewarding high multiple stocks. Maybe they will, especially if the economic growth slows. Maybe we get back into growth. But right now, I think these stocks, there's no way of knowing how much they're going to go down. And I hate to pile on because I do think she's very bright and I do believe in a lot of the things that she says. However, I don't even have a 5-year time horizon. I don't think that's a prudent way of investing, quite frankly.
I mean, if you just look at some of the stocks, right? Not everything is going to get a 5-year time horizon. There's just not enough patience to go around to sit on big losses and stay with the program. Josh, I got Palantir, sold about 5 million shares of Palantir. That's after loading up on it in recent months, and that's with an earnings report and a stock that's gotten absolutely obliterated. There it is, 63% off of its high. That's on Roku, which is in the innovation fund. She defended it yesterday. That's a stock that's well off of its high. Look at that, 77.5%. That takes us to DraftKings, which is another stock that's absolutely getting hammered today. You take all three of those in context of the greater Cathie Wood story, and I'm wondering what you make of it and the conversation that we had yesterday, in which I know you heard all of it.
You know, there's a dynamic in play here that there really is no precedent for. One of the things that ARK is doing that's different from every other active manager in history that's ever gotten to $50 billion in assets is they're playing poker with their cards face up. Every night, we know what all of ARK's trades were. We know what they're adding to. We know what they're selling. That's why you guys in the media cover ARK so much. So it actually was working in their favor on the way up. They would announce that ARK just bought XYZ stock, and a whole army of retail traders would get that news from CNBC, Bloomberg, MarketWatch, Yahoo Finance, and that would almost act as amplification, driving more people to buy those stocks also. And so there was like this halo effect of ARK's latest buy is whatever. So that was great. That went really well for a long time. Raised a lot of money that way, raise your profile, et cetera. But unfortunately, we're seeing that same process works in the reverse. So everybody knows their holdings, and everybody knows that there are redemptions and that there's money coming out. Not every day, but everybody understands that they're not raising $10 billion a month or $10 billion a quarter the same way they were in 21. So if you know that and you're a trader, you have the ability to shoot against those holdings, and you have the ability to even press shorts on those holdings, depending on your level of sophistication. So we've never seen that before. You think about a famous active manager like a Bill Miller, even if he gets himself into trouble and the Legg Mason Value Trust has net redemptions, you don't really know what his holdings are or what his trades are, because he's filing 45 days after the end of the quarter. So a transparent, actively managed ETF has this additional handicap that works against it in an environment like this.
Right.
And I don't know how that spiral ends, but it's tough.